All right, welcome to a financial planning podcast with a down-to-earth vibe. Sasquatch listens while paddleboarding. This is Through the Pines. On this episode, we will chat when to change advisors. So 9 considerations when thinking about changing your financial advisor. 1, are you on track to accomplish your goals? 2, how will your retirement accounts work together with Social Security, pension, ESOP plans, etc.? How much risk are you taking in your investments, and what is the target rate of your return? That's 3. 4, have you reviewed your beneficiaries recently, and have you worked with your advisor on your estate plan to establish a trust, a power of attorney, healthcare directive, pour-over will, etc.? These are all very important. That's 4. 5, will your advisor be able to see you through retirement? Do they have a succession plan in place to make sure you're not looking for a new advisor in their 80s, in your 80s? 6, have you reviewed your insurance needs to prepare for the what ifs? 7, do you know how your advisor gets paid? How are they making the money? 8, does your advisor make it easy to understand financial concepts? Do they speak to you over your head? How are they relaying information to you in a relatable way? And then finally, number 9, do you regularly meet with your advisor or advisors? We will answer these questions, dive into this topic and more on this episode of Through the Pines. So let's introduce our guests in Tan Van today, which is, or not Tan Van, but Trailer One, Banyan One, in the studio because normally they call in. So Rex, it's good to have you. Forbes Best In-State Wealth Management Teams for Utah, Baxter, Nelson and Associates Advisor Hub, fastest growing advisors to watch under $1 billion. Rex Baxter, no longer Nelson and Associates. I'm still throwing it in there. I have it written down as Nelson and Associates, so I don't know what the update is there, but also receivers of the Ameriprise Client Experience Award. Welcome to Banyan One. Like our Facebook page, follow our Instagram at Pines Podcast, subscribe to our YouTube channel where we are live through the Pines Podcasts. All right, should we just dive right in? How are you doing when it comes to accomplishing your goals? And should your advisor know this? Are you on track with what you want to do? And how often should you address your goals? Because they probably change as you go through different seasons in your life. Brandon, you want to start here?
Yeah,
Okay.
Brandon, thanks for having us. And that's, I guess, kind of the first question that you should ask yourself is do I feel confident that I'm going to be able to hit my goals? I was talking to a client once and they told me their old advisor had come out literally with a packet, tossed it on the desk, says, looks good. And they're like,
done. Done.
Yeah,
Party's over.
Like, I don't know. I mean, I guess I trust him, or whatever. And so she actually brought the packet into me and I read through it and there were deficits. I mean, through the second half of retirement, like the packet, black and white and red, showed that they were going to fall short. And
so looks good. So a packet, what is that showing? Like their plan?
Yeah.
Like going through retirement?
I think it's different for every advisor, but
Okay.
This one had, I'm sure you'd input a set of assumptions in and put some of their information in, and then it auto just kind of runs an analysis. Just because an analysis is run, though, doesn't mean that it's really been analyzed. So anyway, yeah, this one, and I showed her. I was like, look, it says you run out of money in this, and this year, and it even illustrates it with a graph. And she's like, what? He just handed it to me and said it looks good. And
so to clarify, these people don't. This is part of your team, right? This is somebody else.
Yeah, this is a different advising office,
a different company altogether.
Yes.
Okay, yeah. just wanted to make sure this wasn't like but someone on your team really messed it up. So okay.
No, but I unfortunately I don't know that that's unique. I worry so often, and I've seen it myself. Other advisors, don't want to take the time. They don't have the expertise with the software. And so they'll actually literally just ask you, a bunch of questions, say, I'll come back to you, and they'll shoot that information off to some other country or something, have someone else run the analysis, and they come back and they're just like, all right, well, it looks good. But unless you've actually run the analysis, Rex and I spend a lot of time in there looking through the cash flows, making sure everything adds up, and then trying to explain it to the clients, right? Because it's good to have a plan, but it's better if you can actually help a client understand the plan, because there's going to be hard times. There's going to be recessions. There's going to be times when clients will second guess what the work we've done, right? And that's important to be able to have something in place such that you can fall back on that and know, hey, we've planned for this. We know what's going to happen during a recession, and we can get through this.
Rex, how do you help your clients reach their financial goals?
We help them invest their money and do their financial planning. That's what we do.
That's too easy. It's too easy. But it's easy to get off track, right?
It's really easy to get off track, and it's interesting when we look at other advisors and their work. You know, I truly believe that most advisors really are trying to do a good job, right? And some are a little more capable of that than others. Some are a little more educated in that than others. And so it's interesting when we're reviewing that and looking at whether it's be the portfolio or the planning to try and kind of re-engineer where they're coming from so that we understand what the original plan was and whether that really makes sense for the client or not as the client, because it's extremely too frequent that a client doesn't understand. It hasn't been explained to him, just like Brandon said, when something's been thrown at him, said looks good. Well, it doesn't look good, right? There's gaps. And maybe, and we have plans that will have gaps, but we make sure that the client understands why there's gaps, where the gaps are, and what we need to do to fix those gaps, if that's a priority to them. Some people say, you know what, I'm going to live the way I want to live today, and I understand that there's gaps, and I'm going to address those down the road, whether that means...
I'm down with that kind of lifestyle. Give me the gaps.
But no, specifically, I had one just the other day, right, where we looked through it and we said, all right, if he dies prematurely, if he passes away in the next 5 years, you're going to need to reduce your lifestyle from, by $500. And then that gives them a decision to make that we're really indifferent on. It's do we can pay for insurance, which in this case would have been kind of expensive, or we can just assume the risk and say, all right, if this happens, then we understand that we have to pull our lifestyle back down to this, and that's not so bad, right? You've lived on that before. It's not a crazy number, but just be aware of that and be conscious of that. Is that a gap? Sure, but it's a gap as long as you understand it. Then it makes sense. And then if something does happen, if someone comes down with a disease, if someone passes away suddenly and unexpectedly, then the surviving spouse isn't worrying, and saying, oh my gosh, like where am I? Is my whole future in jeopardy? They probably don't remember the numbers, but they remember that, hey, we've planned for this, and this is, we'll get through this.
Very good. Okay, so make sure that your financial advisor is helping you accomplish your financial goals. Number 2, if you're ready to move on. How will your retirement accounts work together with Social Security, pension? Now, this is where it gets complicated. So how do you take someone's financial, like their investments, and then compare it with, I'm assuming some software programs, and then just plug in their Social Security, pension, ESOPs, that kind of stuff?
So there's a lot of complex software out there, right, that can run those calculations for us. And so we can put in the Social Security estimates, and we can put in, all of their assets and the allocations of their assets, and then see how that's working together so that we can get to a point, a kind of a break-even point of where does it make sense to take that Social Security. And there's never, because you can't predict the future, you can't tell me how long you're going to live, then there's never a perfect answer going into it, right? And so you're just assuming that, okay, I'm going to assume that I'm going to live to X age, to 88 or to 92, based on my DNA and my family history, and so I'm going to think that I live that long. Therefore, my break even is 87, and okay, maybe I'll go ahead and take it now because I think chances are I'll live that long, but there's a good chance maybe I don't either. And so they'll kind of weigh that back and forth. We'll have an opinion for them as to what we think that they ought to do and a suggestion, but at the end of the day, this is their life and their decision. And so I'm
going to expect every financial advisor to actually have access to that software. So is it a matter of asking, like, if they're using it, or how, like, what separates what you do maybe with someone who's not paying attention to that particular calculation?
So I think the majority have access to software of that nature. I don't know necessarily that the majority either enjoy, like, or know how to use the software.
Okay, fair.
And I think that's the difference, and that's why you end up with reports that get thrown on your desk that say, oh, it looks good, because that's not really their cup of tea.
Mm-hmm.
And you want an advisor.
But that's your cup of tea.
That is absolutely our cup of tea.
So I ran into one yesterday or the day before, where that had been done by another advisor, opposite scenario, where they hadn't paid attention close enough to the software, and they were actually required minimum distributions were throwing surpluses through that they hadn't planned on. Like, I could see that they had just missed it, and because I could see the recommendations they made. And so they told the client, hey, you can either live on this lesser amount, or you can live on more, but it's going to deplete your assets. Well, that's an incomplete picture, right? And that I feel bad for the clients, right? Because now the client's like, oh my gosh, we got a budget. We can't take this extra trip. We can't do this with the grandkids. We can't do these things we want to do, because if we do, we likely run out of money. And that's almost as tragic as telling someone they're good and they're not good, right? I mean, there are a lot of complexities, and it's more than just throwing numbers in and saying, hey, how does that look? You've got to build this plan out and then look at report after report after report and see this financial plan in all different aspects, going through all different types of markets, in order to really be able to help a client understand their situation and the capabilities they have and the limitations they have. Because that's what a plan is. It's not telling you what to do. It's helping you understand your scenario and your situation, such that you can fully live your life to the maximum, possibility that you can get the most out of it.
Yeah, not have to worry about that, I guess,
Yeah.
right? Yeah.
Yeah, I think it's also it's interesting, because a lot of people will say, oh yeah, we're going to do a financial plan on you, and they generate this 900
On
page
you.
book.
That sounds like
It is. It's
yeah.
like a colonoscopy.
Right. Oh, that didn't sound good.
Right. That doesn't sound fun. So they generate this couple 100-page book, and they give it to you, and they think that you're going to read it, and the problem with that is that it's out of date tomorrow, right? And so life happens, and so you need to be able to continue to update and modify and double check your trajectory to make sure that you're on track and that you're headed in the direction that you want to go. And I think that's part of being able to evaluate an advisor as to, are they really engaged in the planning process with me, and is a team kind of approach to where they're engaging me, my wife, or husband, whichever it is, and my professionals, my estate attorney and my accountant, or are they just asking me for bullet points of data and putting together some sort of random recommendation that may or may not really be applicable to me?
Which, I mean, more people are going to say, well, my AI whatever told me to do this, and they're going to challenge your job probably on that side of things. So that personal relationship with your clients and just meeting with them and having those conversations, I feel will be more important to you over time. Have you thought about that?
Well, I think that'll be critical over time. I think that AI is going to be artificial intelligence, right, is going to disrupt a lot of industries, and ours will probably be one of those industries that disrupts for a lot of advisors. The one thing that AI at this point struggles with is kind of the psychology of it, and
Right.
behavioral finance, and
Right.
understanding where people are coming from and their priorities and things like that. It's very good at crunching numbers and very good at scouring the internet to grab stuff and throw it in
Which
front
is
of you.
why I've heard CPAs better watch out.
Yeah, so that's one area that'll be interesting to see. Again, a lot of industries will be disrupted.
Okay, so this one kind of number 3 sort of harkens back to number 1, but how much risk are you taking in your investments, and what is your target rate of return? This is something that I would see would change over time, and potentially change often depending on what's going on in the economy, world events, and your age, or something that happens in family. So again, where number 1 was, are you on track with accomplishing your goals? But then that can change with questions like this, right? Like, how much risk are you taking, and do you need to change that risk factor at any point in time? And how often do you address that, Brandon?
All the time with our clients, but I think more specifically, you need to know what type of risk are you taking, right? If you want to grow your money in a meaningful way, there's risk. Taking risk isn't a bad thing, as long as the amount of risk is calculated and understood. I run across portfolios all the time that they've literally just gone to their 401k and picked like whatever fund did the best last year. And they're taking on immense amounts of risk because they're really not diversified across asset classes, and they're hyper focused maybe on technology or focused on one sector because they really didn't understand how to build that portfolio. And unfortunately they don't realize that until it's too late. And our portfolios, I mean, I take great comfort in the diversification of our portfolios, not only just in various stocks and bonds, but across different asset classes and sectors. And I mean, we really cross-examine these portfolios from multiple levels to the point that, you know, if we go into a deep recession, which, you know, will eventually come, we can confidently ride that through, right? Because we've really built those portfolios to be quite robust. Now, you know, nobody can predict the future. Nobody knows, but when you're in a really robust portfolio, you can do that. Other portfolios, not so much, right? Like if you're hyper focused on one stock or a handful of stocks or one sector that's going under, you may not be able to ride that out. And you might have to be asking yourself the incredibly difficult question during a downturn of, do I just get out of it? Do I cut my losses? And that emotionally and behaviorally can be one of the hardest things you can do. And so I think understanding what type of risk you're taking and the return that you're expecting for that is incredibly important. And you should understand that with your advisor, right? You should talk to your advisor and say, all right, if we went into a 2008 scenario, what does this look like? And how does this work? This is a conversation I'm constantly having with my clients of, hey, if we're getting close to retirement, here, how much do we need to make sure we've got set aside in less volatile assets that will be able to kind of support the portfolio distributions as you work your way through retirement. And those are really important conversations to have.
I think risk is interesting, just to take that on for a second, because I think that, you know, somebody's core risk tolerance, what they can handle, doesn't change drastically over their lifetime. And
I was going to ask you that. I was going to ask you, because keep going. How people assess that and how it changes.
So I think an example of that, right, is I think, Brandon, you've been up Angel's Landing in Zions Park. Have you been up there?
I don't dare.
Okay, so that's a great example.
There's a reason for that. Yeah.
Yeah. So for those that don't know, Angel's Landing is a extremely, I guess, dangerous hike. People die on it every year.
Exposed.
It's extremely exposed, right? Thousands of feet drop, you know, as you're hiking up, and is extremely scary. And so if somebody's scared of heights, right, they're not going to change and all of a sudden 3 years from now say, oh, I want to go do that. Now, they can train to overcome those fears, and I think that they can do that in the market too.
The other question is the people who are young and ambitious and they think they can do it and they get halfway up and they're like, this was a bad idea. And that's what I think you would run into more are people who are young, late 20s, early 30s. They feel like they're risk adverse, they're good to go. And then the down market hits and all of a sudden they're not as risk adverse as they thought they were.
Right. And that's a great example, because as soon as you get into the downturn and they change their mind, they're like, oh, wait, when I said I'm risky, I want 20% returns. I didn't realize that meant 40% losses.
Yeah.
Sometimes too. And so that's where, you know, a good advisor is going to run through a lot of examples. And a lot of times we'll use examples of not only percentages, but dollars, because dollars tend to make a lot more sense to people.
Mm-hmm.
And it becomes more real when they're picturing that. And so when an advisor says, hey, look, this investment may average 7% over time, what does that mean? That means that some years it may be up 20, some years it may be down 20, but over time, you know, through all of those, it may average 7%. But can you handle that 20% down? And people say, oh, 20%, because it's a percentage, it doesn't have a lot of meaning. That sounds really, really easy. And so when you start to put that into dollars, you're like, okay, well, if you have $10,000, if that goes down to $8,000, can you handle that? And they're like, oh yeah, $2,000, I can handle that. Well, if it goes from $100,000 down to $80,000, can I handle that?
Ooh.
$20,000. That's like half a year's worth of income for somebody sometimes. Mm-hmm. And so, I don't know. And then you take that up a notch and you go, well, if we're at $1 million and we lose $200,000 in the span of 3 months, how do you feel about that? And all of a sudden, the eyes glaze over, the face goes white, and heart palpitations, those kinds of things. And so when you start correlating percentages to dollars, I think that's a good practice for people to try and evaluate. Okay, on the downside, everybody's happy on the upside, right? We know this. Most people are, if they make money, they're excited. But on the downside is where it hurts. And so that's one way to quickly gauge how, aggressive you can really handle.
I like when the billionaires lose like 2% and they lose billions of dollars, and it doesn't even phase them because they're loaded.
Billionaires.
Yeah, because they're billionaires.
Yeah.
Like, dude, I wish I had 20 billion to lose 1 billion, whatever,
Right.
10%,
Good problem to have.
2%, whatever. Yeah, it is a good problem. So the reason I don't like Angel's Landing is I had a family reunion in Zion National Park when I was young, and I woke up from a nightmare that I was falling from one of the cliffs.
Oh gosh.
And so the cliff faces in southern Utah have always made me nervous because I didn't even know what I'm like. I woke up from the dream like, why was I at the top of the cliff to begin with? But that's so Angel's Landing is down there in southern Utah and things because we rock climbed.
Yeah.
And I didn't. The mountains don't scare me. It's the cliffs in southern Utah only because that one dream. You're wild, right?
Yeah,
Stuck
that's
with
wild
that
that it stayed with you forever.
Weird. Yeah. Did you have anything else on that?
Well, just I love the analogy because can you hike Angel's Landing safely? Absolutely, right? They've got chains set up. When you do that hike, I mean, it's incredible to me that more people don't die. I mean, I was watching people run around. Their shoes are literally untied, right?
Mm-hmm.
I mean, just stuff that like jumping around the other. I mean, and it goes back to there's certain risks that have returns, and then there's some risks that are just crazy. And it's the same in a portfolio. We can take risk safely, but you never know, and that's true of anything in life. However, if you put certain safeguards in place and you have a plan and you stick to things, it's amazing how safely you can do dangerous things.
But if your advisor isn't regularly meeting with you, and isn't regularly reviewing the risks that's in the portfolios that you have, and kind of retesting your thought processes, then that's an issue. Because
What's regular? Quarterly, monthly, yearly? What's regular?
so I think every client is different. We have some I think it's up to the client as to what regular means to them, whether that's quarter, semi-annual, or annual, or trimester, or whatever period they want. And part of that is probably dependent upon the amount of money that you're dealing with and how close to your goals they are. The closer to your goals, you probably need to meet a little more frequently than if you're 40 years away from your goal. But I do think that too frequent we see a lack of communication from advisors to their clients, especially during extremely volatile market periods, which is counterintuitive, right? That's when you would think that your advisor would be in the most contact with you. But actually the opposite typically happens, to where a lot of advisors, I don't know if they have deer in the headlights, or they're, the phone weighs 1,000 pounds, or any of these other analogies, but lots of times they struggle calling some of their clients because the portfolios are down, and they don't want to call the client with bad news, that the portfolios are down. And yet that is absolutely the best time.
That seems totally normal, by the way.
It does, right? I mean, but really that's the best time in the world to check somebody's risk tolerance. Right? How are you feeling?
Yeah.
Are you about to call me and panic out and make a terrible?
But if you
financial
call
move?
them first, that's huge. Because they're sitting at home like, ooh, I don't know, I should probably call my person. And then the phone rings and you're like, hey, let's chat. I'd feel much better about that than having to call you and bug you and say, hey, well, here's how I'm feeling.
Yeah. So and again, nobody's perfect at that, and I'm sure our team isn't perfect at that either. We try and do a really good job. So hopefully our clients are happy with how we do. But it is the struggle is real.
Okay, so again, this is a lot about review. I'm seeing the trend already. Reviewing your beneficiaries, and have you worked with your advisor on your estate plan, established trust, power of attorney, healthcare directive, all that. And we talked about this on a previous podcast where someone won't go revisit their beneficiaries, and their ex-wife gets the bennies, which
Yes.
So yes, how often do you meet and talk about updating beneficiaries?
So we try to do that every year, right? It's built into part of our review process, and so we try and, because lots of times it's just a quick, hey, this is how it is. We have spouse, kids, or trust, or whatever it is. Is that still appropriate for you? And we have a 5-minute discussion and kind of move on. A lot of people just kind of skip over it. We were looking at one plan, one new client that's coming on board, and they had been divorced and remarried, and on the stepmom's accounts right? It had spouse and then kids, assuming that it would go to the adopted kid, or not adopted, but the stepkids. She hadn't adopted them, but they were stepkids. And she said, well, it says spouse and kids. And yeah, I wanted to go spouse and my stepkids.
It didn't say which kids. It just said kids.
Yeah, a lot of them are generic
Okay.
like that. And that's very common in the industry to just kind of let at the death prove who the kids are, who's surviving and which
Interesting. It
kids.
doesn't say Susie, Joe, whatever. It
Some
says.
do
So-
and some don't. It's you know, and
we can.
we can do it either way,
Yeah.
right? And so, but in this case, it needed to be that way.
Mm-hmm.
We needed to have, Susie and John listed individually or whatever the names are, because they legally are not her kids. And so if she passed, it wouldn't go to them. It would end
Who
up.
just died recently where the will was found crumpled up and it was like a written piece of paper in the couch, literally in the couch cushions, and they just went to court. Famous person died to say like this is actually what she wanted to happen in who the things are supposed to go to. Did you guys hear
I
about
don't.
this
I
story?
don't.
Okay.
I don't think
I'll
I've
have to
heard
look.
that story, but there are a lot. Matter of fact, on one of our podcasts, maybe it'd be fun to look, because there's a lot of celebrities that have passed that don't have appropriate estate planning, and to look through what some of those celebrities'
need to call
estate
you.
plan is
Yeah.
might be kind of interesting at some point.
Okay. Brandon, anything to add?
No, just that we're not. I mean, we're not estate planning attorneys, but we deal a lot with estate plans. In fact, before I came on with Rex, I was thoroughly impressed with how much Rex, really gets into the estate planning, and it's appropriate, right?
I'm getting into some estate planning today.
He'd always ask me all these questions, like, "What are you talking?" Like, I know, what a trust is, but holy cow, this is going deep. So anyway, it's good. It's good to go through and pair your investments with your estate plan and make sure that everything works together, and that you know the pros and cons. Because sometimes it makes sense to just leave a kid as a beneficiary on an IRA, and other times it makes sense to leave the trust as the beneficiary. And so we like to have those conversations with our clients and make sure they understand, again, kind of reoccurring theme, make sure they understand the pros and cons of each decision and let them make that decision.
I'm trying to find it here. I'm scrolling. I saw it, but I don't know where it went. So, okay. So beneficiaries do need to be updated, and meeting with your advisors would take care of that. I guess just people just don't meet with their advisors enough. Like, what's the deal?
Well, so I again, depends on the advisor, whether the advisor has a good process, a good, client service model, and a good client service process to meet with their clients. 20, 30 years ago, it was more of a transactional business. And so advisors would call their client, they would buy a municipal bond or buy a stock, and they would just talk a little bit about, the account and the
Because
portfolio.
you had to, right?
at the
Like, you
time.
couldn't necessarily do that on your own.
That was the
until,
way they
like-
made money.
Yeah,
Yeah.
like
Yeah.
40 years ago, that was kind of the business.
Yeah. Okay.
Right, back
okay.
in the 70s and 80s and before and beyond, and so I think as that's kind of migrated into more portfolio management and looking at modern portfolio theory where you're analyzing risk, that's kind of brought up that service and the expectation of being serviced by your advisors. And yet still we get some advisors that are saying, hey, look, I'm gonna service the heck out of my top 10% of my clients, and then it kind of lacks on down below. And so that can be an issue with some advisors too, is maybe you're not in their top 10%. So,
That's not good.
I don't know.
I've seen advisors who literally, and it's interesting, right? Financial advisors are usually fairly business savvy and numbers oriented, but I've seen advisors who are already well beyond their capacity to take care of clients and will go out and buy more clients, literally just buy them. And they're not even going to call them, right? And
Well, they're expanding their team. See,
but that I was, and that's the plan, right? I'm going to buy them, throw them at the walls, and they know a certain percentage will stick, right? And they'll collect some income off of that, and not plan to ever call them or receive a call and try and help them if they call them, and it's a business model. It's not ours, right? But it's a business model, and I think the numbers work on it. It's just, I don't know. I'd feel bad, I think.
yeah.
Lot of different kinds of business models out there, but I think that's important for you as a client to understand what that looks like and if that's a match for you and what your expectations are.
Brandon, do you have some more numbers?
I do.
Okay.
Yeah, here we go.
This is your favorite part. I need a little do.
Yeah,
more
theme
numbers.
music.
Yeah.
So this is a firm Unbiased. They did a survey. This is just this year, in 2023, and they so a third of respondents felt confident in their financial knowledge. So only a third of people felt and they had a variety of things they asked them, from banking to credit cards to stock market investing, things like that. But only a third of them felt confident in their financial knowledge. 29% said they lacked the confidence due to not being taught the topic in school, and then 82. But this is what was crazy for me. 82% of respondents said that they felt too intimidated to ask or seek financial advice.
Because they're going to get made fun of? Like, what's...
I don't know. I think sometimes people worry about cost, right? Like, what is it going to cost? And that we've done podcasts on that would be good to reference. But yeah, I think people worry that it's going to cost too much. Oftentimes people feel like they don't have enough assets to ask the question.
Or made fun of because they're spending... they have a lot of debt or
I
something.
think sometimes it's an ego thing too, right? They don't realize it, but they don't want to come across as being unknowledgeable or uneducated, or they come across as, oh, I did something stupid, right? And I think that sometimes it's that issue.
Let's just say I'm good at that, so don't feel bad, like put it out there.
Yeah.
Yeah.
So that, I mean, really the only way we know how to work with clients is we throw everything on the table, we talk about it, right? It's kind of a no judgment zone, and we are where we are, and we just start from there and moving forward. But it is interesting, because I think that because of that fear that clients have, that 82%, I think that they don't ask their advisors, and their advisors make the wrong assumption a lot of times that they're not asking because they do know. And I think that that's a recipe for disaster.
Yeah.
So.
Yeah. And what's scary about it is if you're not asking the questions, the things that can be missed, and significant things that we see on a all too frequent basis, where if we could have had the conversation, if I would have known this person 10 years before, right, we could have really changed their life. And without sacrificing a whole lot, right? Just simply making a couple tweaks to allocation, to tax status. I mean, there's a lot of different things that you can do to make a meaningful difference down the road. And if you're not asking the questions, it's going to leave you behind. I mean, some things you just can't come back from, if you don't get it right. And so it's important to ask those questions.
I think it's okay for clients to say, I don't understand that. When an advisor's explaining something and they're saying, hey, look, this should average X, what does that mean, right? Yeah. What does average X mean? Does that, in a 2008 year, what can I expect? Because there's probably another year like that out there, somewhere. And so asking those questions and just making sure that you understand what things look like, I think is important. And I think people need to ask those questions. And if your advisor isn't, or if they're a little bit cagey about it, that should be a warning sign.
Yeah, I could see that too, because they'll probably use a lot of jargon that you might not be used to, and then if they feel like if a question is asked and then like you lose your, you're like, oh, okay, let me go over this, let me start over, then I don't want to ask another question.
Right, right. If they give you an eye roll and they feel bothered, right?
Yeah.
They make you feel like you're bothering them to answer those questions, and I mean all of that, and give your advisors a little bit of slack, right? Maybe they had a bad day, maybe they, right? I mean, give them a chance or two. But, so.
Sometimes Rex feels bothered.
He's catching it already.
No, Rex doesn't ever.
I'd be shocked.
I think people do try and cover up lack of knowledge, though, sometimes with pushing it off, and so.
Well, that's the other flip side of it. Yeah, too, is just using jargon because just to sound like they know what they're talking about. Maybe
just
they don't.
Through it.
Right. Yeah.
Yeah.
Okay. Well, you guys just recently went through. This is our next step or thing to consider here. You just had an advisor retire. We just had a motor.
Oh, I think somebody's cutting down a tree near our campsite. So we must be by some
fired
loggers.
Up the chainsaw?
Hilarious. Yeah. We are in the woods. Okay. So you had an advisor retire. So will your advisor be able to see you through retirement? Do they have a succession plan in place to make sure? Because Rex, now you're getting old. So then
Well,
you got
that's
the
not
young
nice.
buck Brandon here.
Rex promises me he's got 20 years left, right? Rex? Get this official?
You bet.
Or close. We still
Plus
got a
or
while
minus.
with Rex.
Plus or
Rex
minus.
is Rex is gonna be like, I can't give up. I can't stop working. He's gonna work forever. So, but what is the succession plan? Because yes, advisors retire.
They do retire, and I think that that can be extremely disruptive at the later you are in your life.
Yeah.
And so a lot of times you just assume that the person taking over for the previous advisor has the capacity, the knowledge, the interest in taking care of things for you. And that's not always the best assumption. Sometimes it's literally a financial transaction of your departing advisor just trying to sell his practice and trying to cash in on his retirement and trying to get the most money for that. And then the new advisor coming in is going to try and he's got to pay for that practice acquisition somehow, right? And so there's a lot of questions there that need to be answered as far as how are they doing it, why are they doing it. But if there's not a plan in place, like Brandon said, I brought Brandon on years ago now because I do want to make sure that our practice has a succession plan going forward for our entire team. And we want to make sure that there's that continuity so that we don't have a disruption for our clients 20 years from now. Is that what you said? 20 years from now when that eventually occurs.
At least 15.
So it's a ways off. It's a long ways off. I'm not even
because
that's not even on my radar.
That's the flip side of it. Is as I came on, people are like, "Is Rex retiring?" No, better not be.
Okay, very good. So yeah, make sure your advisor ask the question. What's the succession? What happens when you're not here? Right.
Right.
Okay.
Yep.
Have you reviewed your insurance needs to prepare? This is all about reviewing, apparently, this episode. So reviewing, but these are the different things you should ask your advisor about. And if they're not considering these things or asking you these questions, that's when you might need to consider changing advisors. So insurance needs and preparing for the what ifs. How often should that be addressed?
Depends on the client. So younger clients, it's easy to grab some like a term life insurance or something. You have your disability insurance through work. It's different for everyone, but you can usually review it and let that go. For a few years, and we might touch on it here and there. It really just depends on the client, but it's important that you should be able to have those discussions, like the story I shared earlier, right? Where you understand where you're at. Do I have enough insurance? Do I have too much insurance? And I've got clients there too, right? That have more insurance than I think they need, right? But they're like, I want to hold on to it for a little bit.
So much insurance, I should be worried about somebody pouring stuff in their cups.
No, but insurance has a cost to it, right? And so we don't want to pay for an extra cost if we don't need it. But sometimes people get attached to it, and they're like, man, I've had this for 20 years. I've had this for 10. Like, I just want to keep it another few years. And that's fine, right? Going back to, all right, how much are we paying for it? What are we getting from it? And is that worth it?
I do think that on the insurance side that you want to work with an advisor that matches your personality a little bit too. And so some advisors are kind of there's in insurance there's kind of two general big camps, right? You have buy term insurance and kind of invest the difference in premium that you would have paid had you bought permanent insurance. And then you have the other camp of let's buy permanent insurance and then we can borrow against that in our retirement if we need additional cash flow. And there's two, and those camps are very, very different mindsets. And you'll have advisors that feel very strongly about one versus the other. And you want to make sure that kind of matches up with your own values, your own beliefs. And if it doesn't match up, then make sure that they're thoroughly explaining it to you, to your satisfaction, to kind of get you comfortable with the direction that you're going to go. Otherwise, you should look for an advisor that's gonna be more in that camp.
Yeah.
And so,
okay.
Does that make sense?
Yep, totally. Okay, so next one here: what the considerations when you should change advisors? Do they have fancy boots? What was this even on the notes?
I put that on just this morning.
Oh, just this morning.
Yeah.
Oh man, these guys are terrible. These guys are terrible.
Okay. No. Have you reviewed? Oh, this is the insurance. Sorry. Do you know if your advisor, how your advisor gets paid? Well, they all get paid. So how does your advisor get paid, and why does that matter, Rex?
Well, I think it's really important that you understand how they get paid, and it matters because there could be inherent conflicts of interest, right? And so if they're getting paid based on the transaction, which a lot of advisors do, or a lot of advisors have a hybrid model to where on some products and services they get paid on the transaction, and on other products and services they're getting paid kind of an annual fee or what we call an asset-based fee or something along those lines. And on the transactional side, it can be less expensive for a client over time on occasions. On occasions, it can be a lot more expensive. And so you need to understand that. You also need to understand that if it is a transactional based, then what's the motive behind the advisor coming to you to make that transaction? Because there's a fee associated with that, and that's that conflict of interest. And so you need to make sure that you thoroughly understand it and that the advisor can explain it, in great detail to you on whichever side he's on, or on both sides if they're kind of a hybrid advisor. And I think, again, that's a fair question. And a lot of advisors kind of shy away from talking about fees and what they get paid and how they charge. And a lot of clients feel awkward asking an advisor how they get paid, because it's not like it's posted like a McDonald's menu. Hey, here's, a Big Mac for
Not the worst idea, though.
$2.49,
Yeah.
right?
Yeah.
And so it is hard to kind of, to some extent, to post that as advisors, just because so many situations are unique. And so you've got a lot of kind of tweaking of, boy, this may take a lot more time for this client than this client because of the facts and circumstances. And so it's hard to just throw something out there. So most advisors will kind of throw a range out there, but then when they're actually meeting with that individual client, you need to know the specifics. You need to know exactly what you're paying for and how.
Okay. Very good. Does your advisor make it easy to understand financial concepts? We sort of covered this a little bit, but how do you ensure your clients are understanding what you're talking about?
Review. Lots of review. Just
Yeah.
kidding. But really, I think specifically in planning, because planning is one of those areas that can be a little bit harder to understand all the concepts of it. And so I frequently, even after, we'll do the plan, we'll go through it, we'll get everything in place, but then we'll come back and they'll usually ask me, well, what about that mountain chart? Or what about the, and we'll go back and review the same material multiple times in multiple meetings, because I think that's what it takes to really, and each time it's fun because each time you can usually see they're grasping another concept. They're getting it a little bit more until finally they feel really, really confident with what we're doing and why we're doing it. But I think it's review. And it's fun. I was writing these questions up in the high Utah mountains, up in the Aspens at a camp right outside my trailer. It's just like this.
Weird.
But as I was writing these, I was like, man, can all of my, do all of my clients, can they answer confidently yes to these? And I guess I feel really good that I can say, yeah, we've been through these, but man, you forget stuff, and that's why the reviews are so important. That's why we set up these reviews, and to make sure we're meeting with clients, make sure that they're on board, that they're understanding why we're doing what we're doing, because they're complex strategies. And just like the SMORE numbers, right? Like a lot of people don't understand what's going on. And so having these reviews really is so important to make sure, and making sure clients feel comfortable asking those questions. Hey, can we review that again? Can I figure out how again is this all going to work in retirement? Where's the income coming from? What expenses have we planned for? I think it just takes multiple times going through it, not just throwing a packet on a table.
Sure.
There's so much jargon.
Yeah.
I remember early in my career, and you might get a kick out of this, Brandon, but early in my career, I was sitting down with a brand new client, and they just come in, and we were kind of going through their holdings in the accounts. And
Were you alone, or did you have an advisor with you helping you?
so I had my partner Paul with me
Okay.
at the time, and so it was the two of us together, and so but I was kind of leading the meeting, and we were going down through the holdings, and there was this one holding that he had just sold, and it kind of showed up on there, and I said, "Can you explain to me a little bit as to why you sold this particular stock?" He's like, "Well, my advisor said that it was in the third Fibonacci set with a double top." I'm like, "Okay, and what does that mean to you?" And he's like, "Don't you know?" Like, well, I know what a Fibonacci is, and I understand that, and I know what a double top is, but do you know? I understand the jargon. I get the jargon, but do you understand the jargon? And he's like, no. You know? And I'm like, well, what did he put you into? And he's like, well, he put me into this other thing because it looked like a triple bottom that was crowning. And I'm like, well, what does that mean? And how does that impact your portfolio? And how does that impact you?
So he
retiring
knew the
in 6
verbiage,
years?
but didn't know what it meant necessarily.
Yeah, he could regurgitate the verbiage,
Yeah.
right?
Crazy.
Yeah.
But had no idea what it meant. But he thought his advisor was brilliant because of the jargon, right? And
100%. Yeah.
and so it must be good if
Right.
it sounds complicated.
It's got a name.
But you knew the jargon.
But
you
I
keep-
did know the
okay,
jargon,
yeah.
and I understand. I mean, again, we're both
I don't know what
highly
Fibonacci
educated.
is. What the hell's a Fibonacci?
so there's an actual Japanese tool called a Fibonacci calculator. It kind of looks like a protractor a little bit,
Yeah.
and it kind of measures. It's a measuring stick from point to point, and it's supposed to be a little bit predictive in theory about market trends or stock trends or pattern trends. Not even market, but just charting trends.
Okay.
And so there's a school of thought that you could put together a good portfolio by utilizing this to measure when you're buying and selling stock.
Did you know that you can like find water with this thing that just?
I've tried that.
Have you tried that?
Yes, I have.
Does it work?
Oh, I've got a story about
I
that.
don't know.
I've got a story about that.
Yeah.
Maybe, but not for me.
I
What
just
are those
had
called?
a water witch.
A water
So-
witch.
So I just had a client purchase some real estate,
Yeah.
about 40 acres that he's going to build a facility on, and it didn't have any water access. And I'm like, how are you going to have a building? He's like, oh, well, I took this water witch out there and they pointed right where the well should be. He pointed 2 spots where the well should be. And I'm like, and you bought it first before testing? And he's like, oh yeah, these guys are good. And I'm like,
Water witch guys are good.
anyhow, there was a well there. It was deep.
Yeah, they're really
Yeah.
amazing.
It was deep. It was like
Yeah.
450 feet down.
If you dig
Wow.
deep enough, don't you eventually hit water?
I don't know.
Just
I
depends.
mean, I guess you hit an ocean at some point, but
Do you think those sticks really picked it up 450 feet down?
I don't know. But there's definitely, I mean, there's definitely a lot of history
Right?
in people,
And there's a
finding
lot of
water underground that way.
Widgets and
I have no idea.
apps and I mean, there's a lot of software you can buy that all does that stuff with your finances. So, to close this out, I guess. So then, why do we need you, Rex?
Because I have good boots. No.
nice boots.
No, I'm just kidding. But I think, again, we are highly educated. We do a great job of financial planning. We do a great job of managing money and a great job of working with clients to manage their behavioral finance nuances. And I think if you're trying to reach your goals, then I think our team does a phenomenal job of trying to evaluate where you're at, what it's going to take to get you there, and helping you to understand how much risk and what needs to happen in order to get you there, or something has to change, right? We talk all the time that there's only so many variables you can control. You can control how much money you save or how much money you spend. You can control when you hit your goal, so when you retire, whether you're going to work longer or not work longer, and you can control how much risk you're going to take. But when you boil it down, those are the variables that you have control over. And so we do a really good job of helping you understand those variables and working through the combination of those variables to make a plan that's going to work for you.
So this is 9 considerations to consider. 9 considerations when changing financial advisors, and then finally, it's the one that we've repeated multiple times: is do you meet regularly with your advisor? What sort of software do you guys use to make sure that your so and so doesn't get lost? I guess that you continually meet with all of your clients on a regular basis.
So over the years, we've used a lot of different kinds of software. We've used ACT, we've used Goldmine, we've used a lot of different. There's a lot of different kinds of software out there. Currently, today we're using Salesforce as our customer relationship, customer service model manager is what we're using today. So,
But kind of two main things. We have people set up on a recurring service model, and so our clients are set up, and like Rex said, they can direct. Do you want to? I've got one client. He's like, I don't want to talk more than a year, right? It's like literally one fairly quick appointment once a year.
As nice as you are, Brandon.
Yeah, yeah, and you know what? If that's what you want, he's like, I trust you. I have all the confidence in the world. Let's just, and then other clients will be more than that, quarterly or whatever the client needs. And so we've got that pre-scheduled on our calendar so that we don't miss it. And then we also have reports, right? Because sometimes people miss an email, they miss a phone call, they miss a meeting. And so we can go back and look and say, just search and see who haven't we talked to in the last 6 months and make sure that we're getting to people. And that's a good way to make sure that we're actually talking to people. And then once we meet with them, we do have it built out. If we're meeting quarterly with a client, the first quarter of the year, we want to cover these topics, right? Many beneficiaries and there's various estate planning, things like that. Insurance. If we're meeting semi-annual, then first half, second half, and then if it's just an annual meeting, it's all in, all in that one meeting. And so we try to make sure that there's a very methodical way to get through it, so that we're not just sitting down chatting and missing stuff.
Rex, anything else to close out the show?
No, I think these are all great considerations. I think as you're evaluating your relationships, that you look at them. I would suggest that if an advisor or somebody's missing on one or two of these, that you just have a conversation with them first and say, look, I'm not understanding this, or here's a gap that I'm feeling. Can we fix this? How do we work it right? I mean, I don't think any team or any advisor is infallible. I think that everybody makes mistakes, and I think a good open dialogue and a good open communication between an advisor and their clients is important. And I think both the advisor will appreciate it, and I think both of you will leave and have a better and a healthier relationship going forward. If those changes don't occur, then maybe it's time that you start looking at others, right? Yep. And obviously we would love to be considered. So
awesome. This has been Through the Pines. Follow us on Facebook, YouTube at Through the Pines, reminding you to use yesterday's dollars to finance tomorrow's dreams.